A bank account costs nothing to open, nothing to maintain, and pays interest on top. From the outside, the entire arrangement looks like a free service being offered at a loss. Banks are among the most profitable businesses on the planet. JP Morgan alone generates roughly $50 billion in profit per year. That profit does not come from nowhere. It comes from customers, through mechanisms most of them have never had explained. Understanding those mechanisms is the difference between being the product and being the person the system works for. The first and largest mechanism is the net interest margin, the quiet engine of the entire banking business. Every dollar deposited into a checking or savings account does not sit in a vault. The bank lends it out as mortgages, car loans, personal loans, business loans, and credit card balances. The net interest margin is the difference between the interest a bank pays on deposits and the interest it earns from loans and credit products. The numbers make the arrangement clear. The average savings account rate at the largest institutions was between 0.01% and 0.5% as of early 2026. The same banks charge 7% on personal loans, 6% to 7% on mortgages, and over 21% on credit card balances. The depositor provides the raw material, the money, and receives 0.5%. The bank lends that same money out at rates 10 to 40 times higher and keeps the spread. That spread is where banks generate most of their profit. This is why savings account interest rates are often frustratingly low. The bigger the spread, the more the bank profits. The depositor is not the customer in this arrangement. The depositor is the supplier, providing inventory at the lowest price the bank can get away with paying. The second mechanism is fees, the most visible and most avoidable revenue stream. Overdraft fees run £25 to $35 per transaction, averaging $15 billion annually across the industry. Banks and credit unions with over $1 billion in assets charged $5.8 billion in overdraft and non-sufficient funds fees in 2023 alone. And in the 5 years before the pandemic, total overdraft charges range from $11.8 billion to $12.6 billion per year. Overdraft fees transfer billions of dollars of wealth from regular people to banks every year. And the people paying them are disproportionately the people who can least afford them. An overdraft fee, by definition, hits an account that has already run out of money, charging $35 for the privilege of being broke at the wrong moment. Monthly maintenance fees, ATM fees, wire transfer fees, and paper statement fees stack on top. Individually small, collectively billions, and almost all of them avoidable. Online banks have largely eliminated these fee categories entirely, which reveals the truth about them. They were never necessary costs. They were revenue. The third mechanism is one most people have never heard of: interchange fees. Every time a debit or credit card gets used, the merchant pays an interchange fee on the transaction, a percentage of the purchase price that flows back through the card network to the bank that issued the card. The cardholder never sees this fee. It is invisible by design, but the scale is enormous. Bank of America alone generated $7.1 billion in gross interchange fees and merchant income in just the first 6 months of 2026. Interchange is the hidden subsidy that makes credit card rewards programs possible. The cashback points are funded by the merchant who accepted the card. Every reward point, every cashback percentage, every airline mile, funded by a fee extracted from every transaction, quietly priced into the cost of everything everyone buys, whether they pay by card or not. Now the part that matters: how to flip every one of these mechanisms around. Flipping the net interest margin starts with refusing to be the cheap supplier. The gap between a traditional savings account paying 0.45% and a high-yield savings account paying 4.5% or more is not a small optimization. It is a tenfold difference in what the deposit earns, with identical government-backed insurance and identical access to the money. Moving idle savings to a high-yield account takes 15 minutes and permanently claims a share of the spread the bank was keeping. The same logic applies to borrowing. The net interest margin works against borrowers hardest at the credit card level, 21% and above. Every strategy covered in previous videos about eliminating high-interest debt is, at its core, a strategy for exiting the wrong side of the bank's most profitable spread. The person with no credit card balance and savings in a high-yield account has moved from the losing side of the margin to the winning side. Flipping the fee machine is simpler. It is a one-time audit. Overdraft protection turned off or linked to a savings buffer instead of a fee. A bank or account tier with no monthly maintenance fee, which in 2026 describes essentially every online bank. Some banks have voluntarily reformed entirely. Citigroup and Capital One no longer charge overdraft or non-sufficient funds fees at all. Staying with an institution that charges $35 overdraft fees in a market where competitors charge zero is a choice. One that only persists because switching feels harder than it actually is. Flipping Interchange is the most counterintuitive one. The Interchange system cannot be avoided. It is priced into everything. But it can be harvested. A cashback or rewards card paid in full every single month converts the Interchange system from invisible cost into visible refund. The rewards are funded by merchant fees already built into prices, so the person paying with a rewards card and never carrying a balance is recovering money that would otherwise be left on the table. The critical condition is paying in full every month. Carry a balance even occasionally, and the 21% interest instantly erases years of rewards. The card is a tool that pays its user only when the user never pays it interest. The complete flip looks like this. Savings in a high-yield account earning 10 times the traditional rate. Zero high-interest debt, exiting the wrong side of the margin permanently. Zero avoidable fees through one afternoon of account auditing. And every purchase running through a rewards card that gets paid in full monthly, harvesting back a slice of the Interchange system. None of this requires wealth, connections, or financial sophistication. It requires understanding the business model, because the entire system is built on the assumption that most customers never will. The bank is not evil. It is a business, running one of the oldest and most profitable models in existence, with complete transparency for anyone who bothers to read how it works. The customers funding the machine are simply the ones who never looked. The ones the machine works for are the ones who did. Drop a comment with the banking fee that has been quietly draining the most money. The next video covers exactly how to choose the right bank and account setup in 2026, including what actually matters and what is pure marketing.